Awesome. So very excited to present our next opportunity with everyone. I was in Dallas and I met with quite a few of you while I was out there. Again, I feel like we could do a better job letting the community know that we're meeting up because I feel like a lot of you weren't able to make it, but next time we'll make sure we send out reminders a few weeks ahead of time. But for those of you who I did see, it's so nice to be out there again and meet friends and connect with everyone. But I'm gonna host this the way we always do. I know that the community is growing. So many of you are new to the community. The way we like to run this is I go over the presentation and we'll have tons of time on the back end for Q&A. So please keep putting your questions in the chat. If this is on Facebook, YouTube, we'll pull them together and I'll try to get to all of them towards the end. And it could be as basic as I don't understand this terminology, or it could be something very simple for someone who's just starting out. And then if you have more complex questions, guys, about underwriting, I'll make sure I answer all of that. But I'm going to get started, and we'll try to keep this to under 90 minutes in the interest of time. Just a disclaimer, guys, I'm going to go over numbers. A lot of these are projections. And I will also talk about how you personalize your investment based on your situation. I'm not a tax or a legal professional, so whenever you're coming up with a plan, some of you have always already had conversations with me about this deal or about deals in the past, but just make sure you're always consulting your tax and legal professionals. This is educational, and the numbers you're seeing are often projected returns. We do our best to map it out and stay conservative, but I want to get that out of the way. Like I said, I'm going to start off by talking about myself and GW Capital because, like I said, the community is growing. Some of you are probably on here for the first time. And then we'll move on to talking about the deal per se. I know we've had a lot of questions about the returns. We are always negotiating hard for our community and trying to get better returns for our investors. We were able to do that for this deal also. So we're going to talk about how our investors are getting higher returns. We'll talk about tax advantages, and then moving on to the market. The Dallas market is one of my personal favorite markets. I've been underwriting there for quite some time now, so I'm very excited about this deal. And then we'll talk about timelines, and then we'll have tons of time for Q&A. And it doesn't have to be specific to this deal. I've talked to a lot of you, and I always say hop on these webinars it's also a huge learning experience, and I do my best to kind of mirror what's in the slide deck, but also change up the flow so that it's more educational. And so use this as an opportunity to learn more about syndications and how to vet a deal and how to make sure something is conservative. So if you have very basic questions or very detailed questions, anything, just drop it in the Q&A in the comments, and we'll get to it towards the end. Yeah. Okay, let's get started, everyone. Most of you know me. I always see it's always nice to see friendly faces out there. I am Param, I'm a radiologist in Southern California. I used real estate to get to financial freedom at 41, and since then, I started the Generational Wealth MD community. It was started off as a small WhatsApp group, 200 people, and I just wanted a space where people could talk about real estate investing and break those barriers because that's the vehicle I used to accelerate to financial freedom. And I feel like there are a lot of barriers that need to be broken down, which will really help wealth building for high income earners, physicians. And so Generational Wealth MD started with that mission. We are actually we're over 20,000 members at this point. And then GW Capital was born with the intent of bringing vetted passive investment opportunities to our community. We're now at over 300 million in assets under management. We just closed on Cortland Med Center. This would be our next acquisition. And again, like I said, what I realized after 10 years of working as a physician out of training was that I thought I was doing amazing and I had a large amount of passive income. But when in times of crisis, what really supports you is financial security from passive income. And we need to learn how to build that, right? Because otherwise it'll be like being on this hamster wheel and we're constantly trading our time for money. And what I learned was the fastest way to get to becoming financially free and building passive income is to shift your asset allocation. And traditionally, we're taught to invest in stocks and bonds. This is my goal for you. The goal is to get all of you to the point of financial freedom and security. And I think the fastest way to do it, because 90% of a portfolio's returns are from asset allocation, right, is to get to the point where we have 30 to 50% of our investments in alternative assets like real estate. That's what the portfolio of the ultra wealthy looks like. And they do it for diversification. They do it for asymmetric returns, right? Lowering risk while increasing returns, and for tax efficiency, right? All of that contributes to getting you to a point where you have meaningful passive income. So, and that's how I look at it. GW Capital is that part of the community where we're bringing vetted passive investment opportunities to our members, and we go in as general partners in these deals from start to finish. We are a big part of what we do in GW Capital is also education, and a lot of you have had conversations with me. The whole point is to see, because all of us at different points are going to have very different needs, and so it's about helping you figure out what makes the most sense for you, helping you get the highest risk-adjusted returns, adding diversification to your portfolio, right? So market volatility doesn't affect us as much. I don't know if you guys remember 07, 08, I was a resident, and there were so many attendings, and even the chief of our department who couldn't retire suddenly and had to extend, their work period by at least a few years because of the volatility in the stock market, right? That's not the position we want to be in. We want to have diversification. We want to have significant passive income quicker. We're always looking for conservative deals, and our goal is capital preservation and then those tax efficiencies, right? Because that's another tool you're using to really accelerate your path to financial freedom. When we're doing this, we are looking at strong markets always. Dallas is one of the markets I love in terms of demographics, right? Strong population growth, strong economy, very business and landlord friendly. We're also looking always at the deals to make sure they're very, very conservative. I think as a community, as physicians, the focus is always on capital preservation. And then we're also looking at our partners constantly, and we're looking at debt, right? And if you've spoken to me, you know that debt caused a lot of turmoil in a lot of deals that were acquired in 21 and 2022. So we're always looking at the debt, trying to stay conservative there, but also looking at our partners and ensuring that they have adequate reserves and they don't have any leaks in their buckets, which means that in the event that anything happens to our assets, it has the full attention of all of our partners, right? So that's been a focus as we've acquired. This one's missing Cortland, but we're at over 1,500 doors and 300 million in assets under management at this point. I've spoken to many of you, and many of you have downloaded the guide, but for those of you who haven't and who are considering investing passively in syndications, this is an amazing resource. I took months to put this together. I actually gave it to multiple and passive investors who were beginning their journey just to make sure that it was easy to understand, comprehend, and all the terminology made sense. But this is your guide to building your buy box. And I say buy box because if you don't know what makes sense for you, you're going to invest in every project, and some projects may make sense for some people, some markets will make sense for some, and for others, you need a different strategy, right? Which is why even in our deals, you've noticed that a lot of our deals, we have Class A, Class B, like this particular deal in Dallas. And towards the end, I'm going to go over why one would make sense for someone over the other. But you have to build your own buy box. This helps you vet markets. How do you do market due diligence? How do you do due diligence for the deal? It has a due diligence checklist, so definitely make use of that resource. Before we get started, I want to mention our charitable mission, GW Gives. We're helping children in rural India with disabilities with their healthcare and education needs, and all of you make it possible. Some of you have told me you want to contribute towards it. Rest assured, at this point, a big portion of GW Capital and Generational Wealth MD, what we make over there goes towards the mission. So you are contributing, and I want you to take pride in it. Okay, so let's start off with our latest acquisition in Dallas. I've had conversations with so many of you. If you want to have a call, I'm sure Adrian can drop a link to book a call in the chat. But what we're going to talk about today, and I'm going to go through this sequentially. I'm going to start off with why we love this deal, right? And this is true for any asset you're looking at, right? You're always looking at three different things. You're looking at the market, you're looking at the actual investment, the asset, and then you're looking at the business plan, right? And all these three things have to fall in place for us to pick something, which is after we you only see what we pick, but we go through so much in terms of underwriting. We look at multiple deals, and we pass on so many deals, even with partners we love working with. And unless the deal completely checks all the boxes for us, it's not something we're going to go into, right? Because like you, I'm putting my capital into all of these deals. And if there ever is an issue, last year we did a member loan. It was actually this year, member loan. So I put my own personal capital into the deal. So we're always making sure it meets our stringent criteria. But we love this deal. I was in Dallas last week vetting this deal. Um, the market per se, I've been underwriting in New Braunfels, which is where we had the villas in Sundance, and Dallas for the longest time. I love those markets. DFW is the number one city for domestic migration. All right, that hasn't changed in many years. And then this asset per se is just a 25-minute commute to downtown Dallas, so very strategically positioned. And when you're doing market due diligence, that's one of the biggest things you're going to look for. You're looking for population growth. Obviously, Dallas is very strong in that sense. Texas per se leads the country in terms of population growth, but you're also looking at those economic indicators, right? Typically, the Sunbelt states are very business and landlord friendly. There's a lot of migration of jobs happening also. And towards the end, I have all the numbers for the economic indicators over there. All of this, guys, most of this is available in the slide deck. So if you're going through the slide deck, I always say, listen to the webinar first because I pick and choose the relevant points. And then soon I'm also going to do a detailed underwriting video explaining, the nuances of our assumptions and the pro forma. So if anyone's interested in that, just shoot us an email and we can send that to you. But this is just like a big picture overview first, and then we'll jump into more detail. And then looking at the asset per se, I mean, if you guys have looked at the slide deck, and I did a walkthrough video while I was at the asset, and if some of you have laid eyes on it, we'll be adding that to the landing page soon. It's a gorgeous property, the kind of property that you and I would love to live in. It was built in two phases, 2020 and 2021. And the advantage of buying something new, and if you've noticed a shift, it's called flight to safety. A lot of operators have shifted from, say, the 1970s assets to newer assets. And the reason is, in turbulent times, newer assets are what we call core assets, right? They are definitely significantly lower risk, right? You have an affluent tenant base, and there's not a lot of turnover, especially in a community like this, because this is a build to rent community. What does that mean? We're actually looking at 3 and 4 bedroom townhomes in the entire property, right? That's it. It's not a single bedroom, no 2 bedroom. It's not for a roommate trying to someone in college trying to share a room. This is for someone who would go and buy a single family home, right? It's for people with pets, people with kids who, once they get into a place, they don't they don't move around quite a bit, right? They just want to find a place, put down roots and grow there. So the tenants tend to stay longer, and it's essentially buying something, and I feel like I should try to stop myself from getting ahead of myself. It's buying something that is essentially like buying single family homes, but it gives you the scale that we see in multifamily, right? And which means that even at the time of exit, this is something that we can sell to an institutional buyer, or it's something that we can piecemeal and sell off to the to home buyers, right? So multiple exit options. In a sense, all of that makes it a very low risk opportunity. And the best part is the occupancy has been about 96% for quite some time, and that's in a market. If you've seen our previous deals, right? This is in a part of the market cycle, which is normal for market cycles. So we're at the bottom of the market cycle. So it's a time when occupancy is typically lower, vacancy is higher, right? But just this, the build to rent profile of this property and the fact that that submarket has low supply, occupancy is maintained at 96%. So what I'm trying to say is 96% occupancy is normal across market cycles, but for where we are in the market cycle, those are very healthy numbers. very low delinquency just because of the tenant base, right? And then these are luxury townhomes. I'm going to try to get some more videos out of the walkthrough so you can actually see what it looks like inside, and as opposed to just the pictures on the slide deck. But again, a 3 and 4 bedroom plans. Even the 3 bedroom has a large den, 2 large living areas where people could use that as a as an office space if they wanted to, right? Or a play area for kids. Just 1,843 on average, like 1,800 square feet in terms of home sizes, and they have their own backyards and attached 2-car garages. Again, granite countertops, stainless steel appliances, the kind of place that you want to live in, right? And this is the kind of home you want to buy. So a gorgeous property. The business plan is where it gets exciting. So I was talking to the brokers, and rents could easily be bumped up by $200, and that's what they're trying to do already, because of the fact that that kind of product is in a very short supply, right? And so just going in and bumping rents, this is what we call low-hanging fruit, right? This is also called loss to lease. So compared to market rents, when we're going in and the property has lower rents, just bumping that up without really putting a lot of capital into it to rehab the property is going to give us a bump in the income, the net operating income, and that defines the price of the asset. So easily building equity in the property by just catching up on that loss to lease, right? And then again, like I said, and I've been saying this over and over again for the last 2 years, and I believe this is fundamentally what most conservative operators are saying. The two biggest things you need to look at when you're assessing multifamily right now is the debt, and you will see that you will hear a lot of people say that this is the time to take on bridge debt, which is our fixed rate debt. Obviously, because interest rates are going down. Now, what you need to know is that the interest rates we're getting here are based on forward-looking curves. So the rate that's already priced in to some extent. The rate we're getting right now on this asset is 5.2%, and it's fixed. It's agency debt, right? The safe debt that you want to get, as opposed to, I would say, close to slightly above 6% that we were seeing earlier in the year, right? So that's already a better rate, right, which gives us positive leverage. And the two things you need to look at is, and we believe that if you can take a variable out of the equation, right, something that could shift. Yes, a lot of people feel like this may be the time to go and get variable rate debt, but fixed rate debt eliminates a variable, that one thing that could go wrong, right? So it's definitely making it more conservative. If the one thing you can't predict is geopolitical instability. And if for any reason you have variable rate debt and something goes wrong and suddenly your asset isn't cash flowing, this is where properties get foreclosed. This is how investors lose money. So that's not something we're willing to do. Again, there are two opinions on this. I tend to stay very conservative, but keep that in mind as you're assessing multifamily deals at this point, right? So in line with our philosophy, this has conservative fixed interest rate debt on it. And the second thing that you need to look at is, what is my cash flow day one? Now, I've been saying this over and over again, and it's because you'll hear people, and I'll talk about DSCR later, and all of that is just, that's very unique to commercial loans, right? So when you're in the commercial lending space, how you're lowering risk is by ensuring that you have significant cash flow going in. Now, in this project, we're anticipating on average about 6% in terms of cash flow to our Class B and C investors. And if you remember, starting from the beginning of this year, we've seen anywhere from 3 to 4%. The last deal we did in Cortland, again, had higher cash flow day one. Those are the kind of deals, I mean, they're very rare to find, but if you find that, they're unique because they have a buffer, right? So if things go wrong, cash flow can drop a little bit, but you have a buffer. This deal is very similar to that in that, and that's also part of it is because it's a core asset, right? Newer assets have more cash flow, and that's just the way they are, right? So 6%, 5 to 6% monthly cash flow is a very, very healthy number. And that's the kind of buffer that you want to look for, right? So those are two big things. But overall, just because, again, there are small things we will be doing to bump up rents. When I went, all the units have washer and dryer hookups. Some of the tenants are actually renting the washers and dryers, and there's a lease up over there. There's a smart tech package that we plan to put in, and again get a little bump in the rent. But a big part of that the bulk of that increase in rents is going to be from catching up to market rents, and I'll show you rent comps towards the back end, right? So we're expecting up to a projected 20% average annualized return. The key metric you need to look at is, and not just like year one monthly cash flow, but day one, right? And so when we do our underwriting, we take a hard look, we stress test the deal and like to make sure that it's cash flow positive, even after severely reducing vacancy, and factoring in no real increase in rents compared to what it was in the last 12 months, right? So after we do all of that, it still has significant cash flow, and that's something I really want all of you to focus on as you're looking at multifamily in the current economic environment. Okay, apart from that, the fact that it is a build to rent community, again, there's very low supply for that. And at this time, for people who really want, home ownership is prohibitive just because of interest rates where they are and because of home prices being where they are. This is a very, very attractive alternative for all of them. And as interest rates start dropping, we do anticipate home prices to go up. So we're still in an environment where and the demographic per se is also shifting, right? A lot of the younger population wants to rent as opposed to own, right? And so for all of that, there has been a significant increase in the build to rent demand as well as supply. And so we'll talk about that on the back end. But again, it's a very unique space, and this asset is perfectly positioned to tap into those opportunities. Okay, this is something that a lot of you are always asking, right? How are my returns higher? And in this, again, we have actually, I believe in villas at Sundance, we only had two classes, right? So we had Class A, and we had reserve class, and this deal we actually have three different classes, right? So let me go into that again. Class A, guys, for those of you who've invested with us in the past, I'm going to break it down and go a little slow over here, just so that everybody understands even for those of you who are new, right? You see what's happening. Class A is typically prioritizing cash flow, right? Investors in Class A, they get paid first. They get paid from cash flow before Class B and reserve class. And they can anticipate 10% annualized return. So if you put in $100,000, you can expect $10,000 every year that you were in the deal. And that's split up and it hits your bank account every month, right? You do not get profit share on the back end. All you're getting is the 10% preferred return, but it is tax efficient because you still get depreciation. You're not paying taxes on it. So it's not the same as getting 10% from, say, a CD, which you're not going to get. But if you were to do that, you would still be paying taxes on that. You're not paying taxes on this because you still get depreciation, right? And then on the back end, there are ways to defer having to pay taxes. And we can get into that if someone wants to get into it. But that's what you're getting with Class A. Class A is typically for someone who is either, the cash flow is really important to them, and more guaranteed cash flow is important to them because Class A gets paid out first. This is for someone who's looking to cut back within the next 5 years, someone who is retired, and then also for our really low risk investors who really prioritize cash flow and want to be in the capital stack in a position where they get paid first, right? So we have investors in their 30s and 40s who still want Class A, but I would say it's predominantly for those a little later in their career or who are looking to cut down within the next 5 to 10 years. Okay, that's Class A. Now, Class B and reserve class are pari passu, which means they get paid out simultaneously, right? And these are classes where the goal is for your primary goal is not cash flow per se, although cash flow is pretty good in this deal. Your primary goal is to, it's velocity of growth, doubling your capital, right? That's your goal. And the difference would be that Class B has a 50,000 minimum and reserve class has a 500,000 minimum, right? That's the difference. And the advantage to going into reserve class is that now you're getting a more profitable split, right? So your split goes from 75-25 to 80-20. Now, this is what we were able to negotiate for our investors, right? So for our Class B investor, even if you bring $50,000 to the table, you're getting 8% preferred return as opposed to 7% that a retail investor would get. And you're also getting a preferred split. So your split's going from profit split, is going from after you hit 7%, the first 7%, sorry, the first 8%, that's what a preferred return means, right? The first 8% goes to our investors. There's no profit share, following which there's a 75-25 split. Our investors get 75% till 50% IRR, 13% IRR, and then goes to 50-50 split, right? Now that's different for reserve class because they get an 80-20 profit share and they get a higher profit share because of the higher investment. So just to back off a little, Class A is for those who really want cash flow and want a more guaranteed position in the capital stack in terms of who gets paid out first. And B in reserve class is for our investors who are prioritizing growth of capital, right? So this could be those of you who are in your 30s, 40s, you have two incomes coming in, you don't intend to cut back for the next 5 to 10 years, and velocity of growth and higher returns is important to you. And so let's talk about the returns, right? So what do the returns look like? Now, Class A is 10%, right? It's flat. That's what we talked about, which means after 5 years, you get your 100,000 and you've gotten another 50,000, right, over the course of that 5 year whole period. So your equity multiple, what happens to your capital is that it becomes 1.5 times what you originally invested, right? Simple. What happens for a Class B investor? So this is where you're beginning to prioritize not cash flow, but you're beginning to prioritize velocity of growth, your capital growing. Now, even over here, the average cash on cash is between 5 and 6%. So that's a very, very healthy number. And this hits your bank account every month unless something goes wrong, right? If there is a major expense that's not projected. Now, it's hard for something like that to happen in a newer asset, which is why a core asset, a newer asset is low risk, right? It's more common to see that, say, in the 1970s or 80s vintage. But this is what your cash flow is that hits your bank account. But your average annualized returns are going to be 18 to 19%, right? And so you can see that the priority over here is growing your capital, right? Now, again, these are projected returns. I'm going to show you some sensitivity analysis tables after this, but that's what you can expect. Now, reserve class, again, you're getting a more profitable split, like I showed you. So it goes from a 75-25 to an 80-20, and which just means that you're doubling your capital a little quicker, right? And so your average annualized returns are higher than Class B. And so that's the advantage of being in reserve class. And you're getting those preferential splits because you bring a larger check to the table. Okay, so this chart over here, guys, all of this is in the slide deck. It's also on the page gwcapital.com/Dallas. These numbers reflect what you can expect in terms of cash flow during the whole period for classes A, B, and C. C is also called reserve class. So if I say C, I mean reserve class, guys. And it also shows you what you can expect in terms of profit split on the back end, given that everything goes according to plan. And so this is what your numbers would look like. If you put in 100,000 with Class B at the end of the 5-year term, if you're selling as projected in the business plan. So in this, we're not really, so when your plan is to renovate and bump up rents based on renovations and rehabbing a property, that's when sometimes there can be challenges because you may not be able to hit those rent bumps. That's not the strategy over here. So again, the strategy per se, the business plan and the asset are very low risk, but you can expect 100K investment to get to 192,000. That's where you get the 1.9 times X equity multiple, right? That's where it comes from. And this is what the numbers would look like if you invest 500K, right? So take a look at this. This is, I think it's an easy way to understand what your returns will look like. That's a great slide. And then this is just, again, highlighting the fact that when you have a core asset, within multifamily, right? And so this is what your risk return profile looks like. You have new developments, ground up developments, which are higher returns, projected higher returns, but there's more risk in them, right? They're, higher risk and higher returns. Value add is our typical bread and butter. We've done a lot of those, Dawson Forest, Stewart's Mill, right? They're typical bread and butter value add projects where you're going in and rehabbing. And so there's a calculated risk and you get, moderate returns. And then core assets are the new builds, like the asset we have. And typically they tend to be very low risk, but they're also lower returns. But in this particular asset, just because of the rent bumps that we're going to be able to have as soon as we acquire the asset, we're anticipating that and where we are in the market cycle. So that's not something we like to bank on. For those of you who know what cap rates are, the underwriting, the assumptions for exit cap rate, the cap rate spread is minus 0.13%, so almost negligible. So we're anticipating selling it when the market cycle is similar to where we are right now. That being said, most economists anticipate that as rates come down, multifamily markets, the cycle per se is going to go up, cap rates are going to compress, which means we're going to be in a much better market cycle, right? So not factoring that in, we anticipate to get outsized returns for this asset, even with a really low risk profile, which is similar to it's similar to Cortland, the last deal we did, but very different business strategy. That was a tax exemption play, but again, a lower risk asset with outsized returns. Okay. Guys, this is in there. It's in the slide deck for you to take a look at. I talked about the cap spread, and for those of you who are familiar with that, it's one of the assumptions you need to look at, right? When we make these projections, are we being aggressive in expecting the market to be significantly better than it is today? This just goes to show you that we're expecting the market cycle to be very similar to what it is, which in reality, I think it's going to be significantly better than it is because we're at the bottom of the market cycle. But even without factoring that in, these are conservative return projections. But if that were to shift, you can go in and see if the market is better at exit than we expect it to be, then your returns start improving. So this is what we call a cap rate compression. And if the market is worse, then this is where you expect your returns to land. And so it's just a sensitivity table. So you kind of know where you would land. You have a separate one for reserve class, separate one for class B. Take a look at it just to expand your understanding of what the returns could look like. And then this slide in there also, it's an overview of how we expect rents to go up, revenue to go up, and expenses to go down, and what's going to happen overall in terms of the net operating income. And this is what happens in multifamily, right? Increasing the net operating income, so that's income minus expenses, by $1 million increases the asset value by $20 million. Right? And that's because of the fact that in multifamily, your income is what determines your property value, not unlike single family where it's based on how much your neighbor sold his home for, right? And so there's a calculation and, based on cap rates and based on net operating income. And that's the projection. And so I will be doing a more detailed walkthrough and we'll be sending that video out to those of you who are interested. And so if you've done this with us before, I've sent you the underwriting videos, just reach out to us, make sure we send it to you. Okay. So the next question always is going to be, and this is a question you should be asking, as you're assessing any multifamily deal, is it conservative? And I usually like to, oh, I thought I deleted that second part. Okay, sorry, I was working on these slides and I'm always like adding more information in there, but we can go over this. So this is how I like to look at it when we're underwriting deals to see if it meets our criteria. So I'm going to walk you through it and hopefully some of it is repetition, but this is how we de-risk our deals, right? The first thing is going to be debt. And I told you debt and cash flow day one, not year one, because year one can have a bunch of assumptions baked into it. You want to see what cash flow is day one, and we stress test cash flow day one to see what happens if we aren't able to bump rents, what happens if we aren't able to increase occupancy, or if occupancy drops. We do all of that, right? Those are the two biggest things. And so again, debt is very conservative. Our loan to value is 60%, which means we're taking 40% to the table, which is again very, very conservative. It's a newer asset. That in itself means that we're not expecting any large expenses, and we have a better tenant base, and so delinquency is lower. And this is only 114 units, and so that just means that we have 3 to 4 units that are vacant at this point. And it's actually 100% pre-leased, so it's 96% occupied at least for the last year, and then it's 100% pre-leased. But that just goes to show you that the tenant base is very different from what you would find in a 1970s asset. Right? Okay, and then the other thing is high cash flow from year one. Actually, I should shift that to day one, which is what we look at, which is what you should be looking at, right? That gives us a buffer, which means that we have the ability to hold. And anyone who's in the commercial space, the risk is in the debt. And as long as you have the ability to hold on to the deal over time, everything will balance out. Now, the purchase price again is at a discount, and I have a slide later on showing this compared to the cost to build new. And I guess the other important thing to remember here also is that there's limited supply, right? That's probably on the next slide. That's another big factor. Ellis County restricts multifamily construction, which is different, like different counties in the Dallas submarket have different rules. And the good thing about this property is that it's in Ellis County and there is restricted supply just because of the county rules. Okay, now DSCR, this is also a factor of cash flow. Okay, for those of you who are unfamiliar with DSCR, it's debt service coverage ratio. It's looking at what is my net operating income. And for those of you who are new, net operating income is income minus expenses, right? So what's my net operating income? And how does that compare to the annual debt I have to pay, right? My mortgage payments. And so a DSCR of 1.7 means that the cash flow from the property is about 1.7 times the mortgage, which is a healthy number. Anything above 1.2, is okay as per the bank. And this is your average DSCR, right? So it's actually higher in the first year because it's interest only. But a DSCR above 1.7 is a very, very healthy number. Something else we look at is called break-even occupancy. And if it's too much, guys, you can, you just absorb it as much as you can. But break-even occupancy is how low does occupancy need to drop for for the property to be negative in terms of cash flow, and that's in the low 70s. The lower this number is, the healthier it is for the asset. And so again, that just shows strength in the asset, right? In the cash flow and the numbers, how we're acquiring it, the debt terms, all of that. Cap rate spread we spoke about. So it's again a metric to show you that the underwriting is very, so the way the underwriting is the way the calculations are made, or the assumptions are very conservative. Median household income is something you want to look at. Again, that's a very healthy number for that submarket. But that being said, the asset itself attracts very affluent tenants because the rents are anywhere from 2,400 to 2,900 on average, depending on how long the tenant's been in there and whether we've been able to mark up the rents. But it's just a very unique subset of the population. Like I said, it's minimal new supply in terms of construction, but also new supply in terms of the build to rent community, which is more like single family living, right? And then again, so yeah, these numbers, you know, if you were to purchase in the Waxahachie, in Ellis County, in the Waxahachie market of Dallas, submarket of Dallas, your mortgage payment is close to 4,000, and the average BTR home is in the 2,000s, right? So again, it's just showing you that housing affordability is low, and this kind of product has a huge demand. Okay. BTR rents are expected to grow by 20% within the next 4 years. Again, so healthy numbers. We'd like to look at those things actually within the next 3 years. Debt terms, we talked about it, right? And that's what you're looking at, two things, right? You're looking at the interest rate, and you're also looking at the loan to value. How much down payment are we taking to the table in multifamily lending? The more equity you have in a deal, the more you're taking in as a down payment, the safer the asset is, because even if property prices fluctuate, you still have the ability to hold on to the asset, right? And that's what you want to look at. And again, it's fixed interest rate. It's for a 5-year period, so it's not a short loan term, and it's 12 months of interest only. So that gives us a buffer to go in and stabilize the asset. Okay, what are my tax savings? I'm sure we're going to have loads of questions about tax savings. So if you have questions, drop them in the chat. I will get to them towards the end if they're unique to your situation. But in general, a lot of you know this at this point. This is the last year for 60% bonus depreciation, and then it starts phasing out after that, which means this is probably the last deal before the end of the year where you can put in 100,000 and get anywhere from 40 to 60,000 in passive losses. That's what essentially, this is for class A, B, C, all the classes get this, right? That's what ensures that your cash flow from the asset ends up being tax-free, right? Because you have on paper these losses, you're not paying taxes, even though money's hitting your bank account. So that's how you get tax-free cash flow in real estate. What was I going to say? So these losses, if you don't use them this year, you get to carry them forward for future years. This is super powerful, especially for those of you who have any source of passive income, right? So if you had a short-term rental pushing out passive income, if you have a medical practice building with passive income, if you're part owner in a surgical center, endoscopy center, getting passive income from there, these losses can be used to offset any passive income you have, right? And so for most of you, it's probably going to be the income you have from syndications. But for some of you, you may be able to really capitalize on it ahead of time. So yeah, so that's powerful. And then it is phasing out. And so we believe this may be the last opportunity we have this year. The last deal will be going into this year for you to tap into that. Okay. Like I said, it's a two-phase build, 2020, 2021, very, very cute, high-end, luxury townhome style homes. There are 2-level, 3 and 4 bedrooms, very spacious, attached 2-car garages, and washer and dryer in unit. So there's a backyard that's separate to you. There's again, it's almost like it's like owning a single family home, right? A townhome. That's essentially what it is. And like I said, the unit mix is only 3 and 4 bedrooms, very spacious. Even the 3 bedrooms have like a den area that could be an office. And so tons of space. Stainless steel appliances, granite countertops, again, very high-end products. I mentioned a lot of that. The rent comps, all of this is in the slide deck also, guys, and you can go take a look at it. You can see over here that per square foot, rents are lower than what it is in the rest of the market. Now, part of this is because these are larger units, and so it's not going to be as high as smaller units. But that being said, the fact that these are built to rent properties and that they're not really comparable to a 1 or 2 bedroom apartment, that's why we're still able to go in and bump rents. But again, overall, it's still lower than what is in the submarket. So it just shows you that there is room to push rents up. And we're actually seeing that on the ground. I was talking to the leasing manager and, bumping up rents to even 2,900 there's been no pushback. They're able to do that on renewal. They're able to do it on new leases and occupancy stayed steady at 96%, which is a very, very healthy number. And again, if we were to go and build at this time, all-in cost of building one of those units is about 470K, and we're acquiring them for 308,000. So significant discount in terms of what we're acquiring the asset for. Okay, build to rent. So just some numbers, and you'll see actually more information in the slide deck. Just want to hit on some of that, right? It's just a very unique product, and there's a huge demand for build to rent. And like I said, for us, and the question always could be, oh, as interest rates start dropping, what is that going to look like for us when we think about exit, right? And the best part is that that's a moving target, and we'll always reassess that. But if it gets to the point where as interest rates drop, home prices start going up, right? And so that balance is going to happen. But even considering that, at the time of exit, we can always sell this to an institutional buyer, or we can piecemeal it and sell it to individual home buyers also, right? So multiple ways to exit out of it. And that's the beauty of the BTR product, built to rent product. And so again, it's like a single family lifestyle without the cost of home ownership. That's the best part. There's been tons of institutional capital that has been funneled into built to rent because people, especially after the pandemic, people realize that this shift, right, from apartment living to actually single family home living, and the younger population, they want that single family home style living, but they also want the flexibility of renting. They don't want to be tied down to home ownership, and so the BTR space actually fills that demand really, really well. A lot of reasons why this happened. The pandemic was fueled a lot of it. Yeah, and the way things shifted, working from home, that shift that is here to stay. That it's affected Airbnb. It's affected the office space. It's also affected the BTR space, right? So the shift happened during the pandemic, but the trend is here to stay essentially, right? And so even like I keep mentioning this, right? The younger population really just wants to continue renting. These are people who are renters by choice, and the BTR segment caters to their needs. These numbers, I think we kind of looked at it before. It's housing affordability again. It's throughout the country. For a lot of people, it makes sense to just rent. Now moving on to submarket data. Some of you are already in Texas, and you understand the submarket really well. And I had conversations with a lot of people who own there, who live there, who operate multifamily in that location. But there's this proximity to tons of employers. The Blue Star land development is where tons of tons of capital is being funneled into this mixed use development, which is within 15 minutes of the townhomes at Bluebonnet. Baylor Scott and White Hospital, again, a lot of hospital systems, and the fact that this is very this access to get to downtown Dallas is about 25 to 30 minutes, depending on where you're going, right? So ease of access. That's also, traveling down south and going up, you're not hitting the same traffic that you are when you go up north. And so this is the next wave of growth and development as far as Dallas submarkets go. Again, this strong submarket absorption. Now that is something that we're looking at more and more now because during the pandemic, there was a lot of new development happening. And so tons of supply hitting some markets. And again, this is very submarket specific. And like I mentioned, Ellis County. So Ellis County has led the Metroplex in occupancy, and that's because they restrict supply. That's the best part, right? They restrict supply. There are probably 3 other units in the county that are coming that are coming on the market. One of them is for senior citizens. And it's because they don't want to stress the school system, right? So they're being very intentional about that. And then the two other products, again, aren't in competition with our build to rent product. And so Ellis County absorption numbers are very, very strong. And that's something we look at closely also. I believe we've talked about all of that. Dallas per se, population growth. So it is really, really strong. So the data says that every 3.3 minutes, one person is added to Dallas population, which I think is pretty interesting. And again, it's for the multifamily market. It's the number one place a lot of investors want to invest. That's because of the strength of the demographics, right? The population growth, the economy growing, and the fact that not really a lot of natural disasters happening over there, right? And so job growth, tons of job growth. It's the world's ninth largest economy with close to 2 trillion in GDP. So a lot of diverse industries. So Dallas, um, there's so much industry diversification that between 2015 and 2020, when there was a slump, for other Texas markets, Dallas and Austin didn't see that, right? That's because of their diverse economy. And that's something that makes it a very attractive market. Austin's a little different in that the numbers sometimes don't make sense because rents haven't, that rental growth hasn't been there. Dallas is a little different in that sense, right? So the numbers still make a lot of sense, and the economy is very, very strong. So this is a slated 2024 completion. This is the mixed use development that I was talking about, and it's within 15 minutes of the actual asset. It's a $29 million project, and so again, tons of capital being deployed over there, a lot of growth happening because people are seeing the potential in it, right? I mentioned this already. Dallas, Texas per se. Texas is business and landlord friendly, which is why we're seeing the growth in population and in the economy. Okay, so again, healthcare is fueling a lot of the jobs in the submarket. There's a lot of migration of companies. We all know this, where this has been happening since the pandemic. Companies are moving from California to Texas for that very reason. The fact that it is a very business and landlord friendly economy. The Dallas is going to host the 2026 World Cup. There's a lot more information about the Dallas market per se within your slide deck. So go take a look at it. This is also a partnership that we have with Viking Capital. We've been in some deals with them in the past. I want to end before I end. I want to discuss this because a lot of you, I think a question for a lot of people is, okay, do I invest now or wait? And that has been a question, I would say, for the last 2 years. But I've kept mentioning this, and you've probably seen this slide if you've been to our previous presentations, but this is where we are in the market cycle right now. We're actually on the upward trend, right? Because rents have gone up. And so we were here for the longest time, right? On the downward trend, and we're actually in recovery right now, right? So we were in recession and we're in recovery at this point because rents are going up in multiple submarkets across the country. Interest rates are going down, and they actually cut interest rates more than we anticipated. And so all positive signs, right? And so we're on the upward trend. It is a time of maximum opportunity. Ideally, you want to be tapping into this. Now, you don't want to time the market at all, but if there was a time to time the market, it would be now. And this is what these are the national multifamily projections going forward from 2024 to 2027. And so as interest rates drop, multifamily assets. Now, this drop in multifamily asset value. Now, like I said, if you can hold on to the asset, if you have the right kind of debt and you have good cash flow, these drops don't affect you. It does affect you if you have variable rate debt and if you don't have sufficient cash flow, right? If your DSCR is under 1, that's troublesome. But this drop you did not see in the single family space. This is unique to the multifamily space, which is why there's, again, as rates drop, you will see an uptick in asset value. And so if you are looking to deploy, this is a great time to deploy. A lot of us have capital in a savings account. CDs have been, giving us close to 5%. What I want to highlight is that it's typically taxed at your marginal tax bracket, right? So that 5% dividend or interest that you're getting is taxed at your marginal tax bracket, which means you're at close to 2.5% to 3%. And inflation is at 3%. So that's, you're barely keeping up with inflation. And so going back to the slide I showed in the beginning, there is a place for, fixed income assets. and there is a place for stocks and bonds. But what I want you to be intentional about is setting your asset allocation for alternative assets. And that's where real estate comes into play because you're using leverage, because it's inflation control, it's indexed to inflation, it's tax efficient. And there are so many ways where we can appreciate the value of the asset without waiting for market appreciation, right? A lot of unique features, which is why it needs to be you need to be intentional about your asset allocation when it comes to it. And so I want to leave you with Warren Buffett's quote, be countercyclical. And this is the time to honestly, the way you interpret this is go with the data, not with your emotions, right? And so if you're looking at data, we're always, and this slide hasn't changed, guys, in the last 2 years. And honestly, it really doesn't change across market cycles. Just have to be more intentional about it, at certain times. And you have the ability to get discounted assets, which is where we are right now, right? So you always want to go into strong markets. You always want to be positive cash flow day one. The higher the cash flow, the better position you are. Your ability to hold depends on the debt, and you want to make sure your assumptions are conservative. And hopefully, I've touched upon some of the assumptions, so it gives you an idea of how we look at things, and it helps you make those decisions and do your own due diligence on the asset. Okay, so when you are acquiring at the bottom of the market cycle, right? So something that's typically $1, you acquire it for 0.7, that's when you're making outsized returns, right? So we're in that part of the market cycle where we have the ability to do it. So I want you to really tap into it. And that's what education is about, right? It's helping you really do your due diligence so you're able to lower your risk while increasing your returns in the profile in your portfolio. Okay. The expected hold term is 5 years for this deal, which matches the loan term. Now, that being said, starting year 3, we will start looking for the optimal time to exit. And so it'll depend on market conditions, right? But the underwriting is for a 5-year hold period. What is the minimum investment? We talked about that before. It's 50,000 for Class A and Class B, and then reserve class to get those enhanced economics. We're looking at $500,000 minimum. Can I use IRA funds? And so we are planning a podcast with the IRA Club. I believe on the 17th of October, and we're going to deep dive into this. And so even if a lot of you are also in the in our coaching program, right, in creating generational freedom, we started a new cohort. And so some of you are new, and as we go into it, we'll be talking about creative financing and using IRAs. And so that's why we kind of timed it. So it would be close to your starting the cohort where we're going to talk about how you can use IRA funds, but you can use them to invest passively in syndications also. And if you have questions relating to that, make sure you bring them to our chat with IRA custodians, which is, I believe, on October 17th. Okay, so Class A or Class B, I think when I was on that slide, I think I was compelled to talk about it. So hopefully you have enough information. But if you have any more questions, specific questions, please feel free to drop it in the chat and we can go over those questions. But I actually have a slide. So Class A is for the safety seeker. It's someone who's either at the stage of their life where their cash flow from real estate is sustaining their lifestyle, right? Or it's someone who is very low risk. And for those people, it's Class A. Class B and reserve class is for your planner, someone who's looking for, who's looking to really use leverage and real estate as a tool to have velocity of growth so they can accelerate towards financial freedom faster. This category is more for ground up developments, which is not what we're doing. So that's what you need to think about. GW Capital Fund 1, we get a few questions. We are investing through GW Capital Fund 1. It is a customizable fund, which means you get to pick and choose every asset that you want to go into, and you won't get to say how much you want to put into it. And so it's your custom-made portfolio. Okay, we aren't making any decisions for you. The reason we use the fund is for 2 reasons. We want to enhance investor experience. You get a single K1. Everything's housed within it. So you're, one portal, one location, all of your documents are in there. And once you set things up, it's set up for all of your investments. So you're not piecemealing it. My God, that scared me. Adrian, would you be able to mute them? Okay, I may need. Guys, someone is unmuted. Would you be able to mute yourself? Okay, let me see. I got it. Okay, perfect. Excellent. Let's go back. Hey, Sagar. I met I met someone at in Dallas with the same first name but a different last name, and I mistook them for you. But funny story. Anyways, going back to this, guys. So it's investor experience. We want you to have a single K1. Everything's housed in one portal. You're not going in setting up your instructions and doing the paperwork over and over again. It's very, very simplified for you as an investor. I know that when tax time comes, it's hard for me to go to all my different brokerage accounts and pool everything together, right? So it's one place. It's almost like having a Merrill Lynch account where you have different investments in there. You get to pick and choose where you want to be, but you get a single K1 at the end of the year. You get a single 1099 over there, here a single K1. And so that's what we've done. We've also reduced fund costs significantly. It's down 75%, and that's because we want to ensure that we're maintaining high cash flow for our investors. So unlike other funds where you're there are higher fees in there. That doesn't exist in our fund because our fund is very cost efficient. And the big reason why we made the shift is because we wanted to be in a position where we could negotiate preferential returns for our investors, which we have been able to do in all of the deals that we've been in through the fund. Okay. And so that's something I'm super proud of. But you still get to personalize your return within the fund. You get to pick and choose what you want to be in. Really, it gives you the ability to diversify your portfolio and still tap into those tax efficiencies. Okay. So that's about GW Fund One. Next steps and timelines. So guys, Class A, so you have to be an accredited investor to invest in the deal, which means either you or your spouse needs to individually have 200K in income for the last 2 years or combined income of 300,000. And or right, either of those criteria, right? Or you need to, it's so either one of those, either 200K individually or 300 combined for the last 2 tax years, or net worth exceeding $1 million, either individually or jointly, but without including the equity in your primary residence. So you need to be an accredited investor. The last date for soft commit is going to be the 25th, but Class A is filling up very, very fast. So if you are interested in Class A, please soft commit as soon as possible because we have Class A gets filled up quickly because we have a much smaller allocation for Class A, because having a higher Class A allocation drags down returns for our Class B investors. So there's a very limited allocation, but we do want to cater to those of our investors who really want steady cash flow, and so that's why we have a Class A, you know, uh, a separate class built in there for people who prioritize cash flow. If for that, I don't think the deadline is going to be the 25th. We're probably going to fill up very rapidly. Typically within a day or two of the webinar, Class A fills up. So if you're thinking about that, I would encourage you to, to fill that soft commit out quickly. You would go to gwcapital.com/Dallas and fill out the soft commit over there. If you scroll down, you should see the soft commit. And then the funding deadline is going to be the 28th because we hope to close mid-November. So those are the timelines we're looking at. That's it, guys. I'm gonna, sorry, wrong link. It would be gwcapital.com/Dallas. My bad. I was working on these slides. And I did not take a look at that. So that's going to be gwcapital.com/Dallas. I believe the QR code is accurate because the team put that in. That wasn't me. I made that error on my part, but that's how you would be able to soft commit. The replay is going to go up there. Also, the slide deck is on there if you're looking to access the slide deck also. So that's where all the resources will be housed. Okay, awesome, guys.